2026, the biggest mistake won't be buying bad real estate. It'll be sitting in the wrong kind of safety. So I've seen this story before. 2009, Northeast Florida, there were a lot of people staying in what's known as safety by being on the sidelines. Now, this has just been after the biggest real estate correction in the last century happened. Areas that were so highly regarded, like California, Florida, were now the death zones for investing, and people did not feel safe coming off the sidelines, even though there had been number corrections and the fundamentals, the cash flow, the buy-in amounts were making a lot of sense. People don't feel safe. They don't want to invest. But again, as Warren Buffett always says, it's be fearful when others are greedy and greedy when others are fearful. That's what I'm seeing in Florida here almost 20 years later. And the way I know is the money that's going into the real estate markets in Florida. I'm going to share a list with you that's going to prove that there is real money coming into Florida, and it's the people with the most experience and the least emotion. And they're bringing a lot of money into Florida right now, which is making a severe dent in the market and creating a quiet upwelling. And that upwelling, well, we're going to see from what is being estimated now, big growth patterns in certain markets in Florida through 26, 27, and 28. Let's go over those now. So we keep going back to the same thing. And again, we could try to get fancy. We could kind of try to switch it around. But why do that when the one word that makes the most sense is affordability? Affordable housing, workforce housing was left behind in the last uprising of Florida real estate. And that has been shown in many of the videos that I've done. And since the rates went up in 2022, June of 2022, all permits, for the most part, came to a screeching halt. And a lot of the big institutions went onto the sidelines. This doesn't surprise me in these unknown times. They felt like there was going to be a correction, and there was. Through the last 3 years, from mid-2022 to mid-2025, there was a drop in all real estate, some more severe, with the ones uprising the worst in the emotional markets, which I always talk about. Properties priced twice above the median value. These places are getting crushed. The low interest rates felt people could be bigger than they really were, and now they're stuck in a property that they can't resell because that larger loan at the higher rate, that's going to put someone completely upside down, and those properties never would have cash flowed anyway, almost even with the lowest rates possible that we saw in 2020 and 2021. However, there was a segment of the market that was underserved and had cash flow right off the bat, even in solid areas, even with new construction. And this was the workforce housing. The property is priced just below the median. We're talking about residential real estate here, single families, duplexes, quads, things you could get residential loans on and that people like to live in. Again, there is always a competition between smaller unit properties like duplexes and quads and apartment buildings. Now, these are completely different types of living. Both of them can make money. I have a lot of friends that make great money in the apartment sector. But for smaller investors, getting into the right select few properties, if they're going to own their own real estate portfolio, is absolutely key. And where a lot of people made a lot of money and are still sitting in a great position are the new construction workforce housing. This again was underserved, and if you got in with a low rate, then you were able to produce some incredible results. Now, what we've been hearing from a lot of people over the last few months, Florida has just been getting inundated with bad press saying, oh, Florida's going down, this ranking of the worst markets in the nation with Florida. The problem is, as we've talked about, there's 29 million people and there's several sub-markets that all get mixed together. You cannot put workforce housing in the same dimension even as these more luxury homes, as land. This is a totally different market, totally different investment model, and totally different returns that are available today. And when you stop to think about it, the reason that you buy a house as an investor is a house is worth what it can rent for. Because when you start with that, the rent, again, sets the stage to be able to have the longer growth patterns of debt pay down and appreciation, where if history repeats itself, is bound to happen as long as there's good underlying fundamentals of population and jobs and other amenities that people have desire to live there. And what we're seeing with Florida right now is there's a large segment of unemotional, very educated money coming off the markets that sat on the sidelines for almost 3 years. Remember, we're builders. We build for individual investors like yourself, but also the larger institutions and family offices have been coming to us to find out exactly what we could offer In the last 6 to 10 months, they have quietly stepped back into the game to fill a gap that we've been talking about, that we've been seeing in workforce housing just in Florida. So what I wanted to actually do with you today is I want to read to you a list. I have it pulled up here on my computer. I'm going to read to you a list of the properties that we're actually either under contract to build or we're in the process of bidding them for some of our institutional partners. Again, this is workforce housing. That's starter single-family home, duplexes, townhouses. These are the starter levels where there's still a high demand. These guys do their own research. They have their own research departments, and they come to us just for the build. But what I know about these guys, again, they don't really have an emotion. They look at the numbers and they look at what they believe is going to happen in the next 5 to 7 years. For each of them in Florida, they are feeling like they need to rush to get units on the ground because as that COVID supply goes away, and we've talked about it many a times, beginning of 2024, it came on, there was still absorption, but so much came on that it felt like nothing was absorbing. Well, now that's going away. So there's going to be a great need for affordable housing to go on the ground in key markets in Florida. And again, it's easy to talk because talk is cheap, but where are some of these bigger people writing their checks to? Let me tell you right now. So this is a couple of the markets that we're either building workforce housing on or that we're bidding to build the next group of housing for these groups. 297 housing units in Naples, Florida, 44 units in Davie, Florida, another 48 in Davie, Florida. Pensacola, Florida, 252 housing units. Orlando, a 208 housing unit project. Pasco, Florida, 109 housing units in Pasco, Florida. 250 housing units in Ocala, Florida. 178 in Kissimmee, Florida. 145 housing units in Port Pierce, Florida. 180 more housing units for a project in Ocala, Florida. Again, these are clients that have come to us with their own properties and asked us to build because they believe now is the time to come off the market and be ready. 51 more units in Orlando for a smaller housing unit project there. 230 units in Zephyr Hills, Florida. 166 housing unit development in Orlando, Florida. 108 housing unit development in Jacksonville, Florida. 106 unit in Freeport, Florida. 65 housing unit in Tampa, Florida, and another 121 unit housing development in Tampa, Florida, a 240 housing unit development in Sarasota, Florida, 228 unit in Panama City, Florida, and then a smaller 79 unit housing development in Panama, Florida, another Jacksonville one, 157 housing unit. Again, this is all affordable workforce housing, 220 units in Cocoa, Florida, 266 housing units in Daytona, Florida, 120 housing units in Gainesville, Florida, and finally another 166 housing unit development in Orlando, Florida. Again, that is thousands of units coming online where people have already either put up deposits and are building them or bidding them out to start as soon as possible. Why? Because they believe that we are in a serious issue of shortage on this type of housing. That entry-level rental demand is still there. Again, for every 100 renters in affordable housing, we only have 25 houses available. But the problem is we skew all the segments and we put all of those luxury and more emotional properties in with the ones that have actual demand and numbers. That doesn't work too well. You got to look at the workforce housing supply gaps. And again, these guys are unemotional. They look at their dollars with a lot of professional analysis and they say, where is it needed? Where do we believe the market will have growth in the next 5 to 7 years? And these guys can go national. They can go to any of the 50 states that they choose to, or most of the states that they choose to. This is where they've chosen to put their money. These are the institutions and family offices that we've built for a long time. And it was very interesting to watch them come off the next descent 6 to 10 months. So the question I always ask then is, are you wanting to be that little fish swimming next to the big fish? That's how I've always operated with my own portfolio. I would follow bigger investors to see what they were doing and try to chunk off smaller properties for myself because they probably had information that I didn't that was positive and could get me where I want to go. That's the same thing here. It always makes me chuckle a little bit when people who probably don't even invest in real estate and just commentate real estate don't even look to see what the larger institutions are doing and where they're actually putting their money into. This is where you should be looking. Where are the actual check writers making their deposits? And that's why I wanted to read this list to you. This is something you have to consider. You want to go where there's large money supplies being dumped into. You can name all sorts of industries and markets, but especially real estate, where there's money brought into a market, it raises the entire market. Now, and that's going to start from the ground up with affordable housing, which is in high demand. I do think that will help stabilize the rest of the properties. Those more luxury, emotional ones, they're going to have more correction. But again, I do think there's going to be a buoyancy and a correction there that's needed because of shortage of demand. Remember, Florida is still at about a net migration of 497,000 people a year. That's still tremendous. One of the top in the nation, not as high as during the pandemic, but still very strong. So the question I ask you is, are you looking at the people that are actually writing checks and putting real money into markets? Or are you talking to people that are just commentating, that are just giving you news or trying to get you to click because they feel that they want to get your attention and maybe in for something else or to sell your house for a lower price? These are all fair and fine. But again, if you're truly wanting to be an investor in the next year of 2026, I would look to see, where are the real players? These people with large amounts of monies and no emotion and a lot of analyzing departments behind them. Where are they going? Where are they depositing their money? You should follow the same. In addition, there's a reason why these institutions have really changed their tune since 2009. See, I was around in 2009 when they were buying side by side as I was buying up a lot of real estate in Northeast Florida. Like all of us, we were buying older properties to fix them up, rent them out, and go that route, and they can make you money. However, the ride can have a lot more bump to it, a lot more maintenance and repairs, a lot more turnover, a lot more surprises. The amount of institutional buyers now buying the older portfolios, there's still some out there, but it is dropped tremendously. Again, these guys do their numbers. They are unemotional, and several of them have come back to us. Some of them we worked with larger bulk portfolios and foreclosures way back when. But now, especially in the last 5 years, they've come to us and said, new construction, setting them up purpose-built, and having that advantage right in those first few years, which are pinnacle to get the property moving in the right direction, some rental growth, some equity growth, some debt pay down. They said the best way they've seen that by the numbers and by time, because they don't like to waste any more time than they have to, is new construction. That's why we're so busy. That's why people say, oh, well, if Florida is so overbuilt, why would these institutions be putting down large dollars to build more units? You have to look at that. You have to question that, because that's going to give you the answer of whether should you stay on the sideline or should you invest. So remember, as we talked about in the beginning of this, there is safety on the sidelines, at least in the short term. But what I've found is if I had not stepped back into markets like I did in the early 2000s, in 2009, and right now, then I would not have made a majority of the money that I've made over my real estate investing career. So look at this the same way. Not every property is created equal. Not every segment of the market is created equal. And certain types of properties have better advantages to them. So do your homework on that and look at what the big guys are doing. It's an easy cheat sheet. It's a way for you to get comfortable with possibly putting your money into a deal, because even though you're not investing with them, you're almost investing side by side with these larger groups. And that, for me, is a huge safety score, because I like to leverage off their real estate. So if you want to learn more about where we're building for people, the type of properties, click the subscribe button, because I'm going to be going over that over the next few weeks.